Learning Objective C, describe how a consolidated statement of cash flows differs from a single entity's statement of cash flows. So in the past two learning objectives, we've been discussing why there's a need for a statement of cash flows and demonstrating an understanding of some of the definitions per AASB 107. In this learning objective and the next, we're going to sort of now apply what we've learned and discuss a few more issues with a consolidated statement of cash flows preparation, and I guess these two objectives will be the more practical side of the topic. So typically, and something you may remember from first year, a typical question that involves preparing a statement of cash flows involves using the existing accounts that have been prepared, say the statement of profit and loss and other comprehensive income and the statement of financial position, which is prepared using accruals data, and the additional information provided in the question. And from that we reconstruct each account to figure out what the actual amount paid or received during the period was, and that's the process that we go to in preparing a statement of cash flows. Now, while a consolidated statement of cash flows is very similar to what you did previously with a single entity statement of cash flows, there can be some differences in how the data is derived. As it says here specifically, the preparation of a consolidated statement of cash flows becomes more complex when there has been either a subsidiary acquired or disposed of during a period. And with the introduction or removal of these account balances from the acquisition or disposal, we need to consider how the various cash flow items are derived. So we'll go on to the next slide now and have a look at an example of how a acquisition can of a subsidiary can change the preparation of a statement of cash flows compared to what we probably used to. So in this example, Big Ltd Group acquires all the shares in Little Ltd for a cash consideration of $9 million, and that was during the year ended June, let's say 2011. There was only an asset of property with a fair value of $9 million as at the date of acquisition within Little. We're assuming that there are no other transactions during the reporting period for any of the entities within the Big Ltd Group. So the consolidated accounts within all the entities within the economic entity, there's no other transactions. The statement of cash flows of Big will show a cash outflow from investing activities of $9 million for the purchase of shares in the subsidiary. The reduction in cash for the group for the reporting period will also be an outflow of $9 million. From a consolidated perspective, the balance of property has increased $9 million as a result of Big acquiring all the shares in Little. So the transaction that occurred with this acquisition was a credit to cash $9 million and a debit to property, plant and equipment $9 million. When we prepare the consolidated statement of cash flows, however, and consider any cash inflows or outflows relating to the purchase or disposal of property by the group, the $9 million increase is not considered a cash outflow, as it was given as an asset acquired by the way of a business combination and not a cash purchase. So within the consolidated statement of cash flows will be classified as an outflow for the acquisition of Little Ltd, and it states within AASB 107 paragraph 39 that cash flows from an acquisition or disposal has to be separately shown as well. So even though the acquisition entirely relates to the purchase of property with a fair value of $9 million and a cost of $9 million, it's considered an acquisition of a business. and recorded as such. Prior to preparing the consolidated statement of cash flows, there's a bit of working that needs to be done in calculating what the cash paid or received is for each respective account. And to do so, we either prepare ledger account or T account reconstruction entries. So either of these methods is acceptable. You can do either method, whichever one you're most comfortable with. The textbook uses the ledger account reconstruction method. However, first year accounting and maybe in management accounting as well, you might be more used to doing T accounts. So either it's fine to do whichever method you're most comfortable with. So reconstructing the accounts involves 3 steps. The first step is to identify the accounts which are considered cash equivalents. Then compare the current and prior year's closing balances within the statement of financial position. And then the third step, reconstruct the accounts using the information provided from the statement of profit and loss and other comprehensive income and the statement of financial position. And I guess use any additional information provided in the question where necessary. So within step 3, you need to record the opening balance and the closing balance of the respective account, and then include the entries which are non-cash transactions for the period, say the expense or the revenue received, and then from there you can determine the amount of the cash receipt or payment that must have occurred for the account to reach that closing balance. So for example, rent payable, the opening balance would be a credit, so that's the payable that was still owing for rent at the beginning of the period. And then if we were to have a rent expense for the period, we would debit rent expense, then we would credit the balance of rent payable, so that would increase the balance. And then if we were to have the closing balance, that would decrease the balance. And then that residual figure, what's the difference between the opening balance plus the expense less the closing balance? That would be the amount of rent paid for the period. So it might be a bit difficult just to understand what I'm talking about without seeing it actually in a T account or a reconstructed ledger account method. So we'll go through some examples in the following slides to provide some more context. The last point down here says that financing and investing cash flow items can often be determined without reconstructing the accounts. So quite often you'll find the information regarding these within the additional information, not part of say just within the statement of profit and loss and other comprehensive income and the statement of financial position, and you've got to figure it out. It will be stated in the question as additional information. So preparing a statement of cash flows. First item on the list would be the cash flows from operating activities we need to consider. And here we have a useful table that you can use to help understand the relationship between the ledger accounts for operating activities. And we've got listed here cash receipts from customers. That would be the first account you reconstruct, and that consists of trade receivables and the provision for bad or doubtful debts. If there is doubtful debts, you first need to figure out whether there's any bad debts written off, and then that needs to go within the trade receivables. That flows through to the trade receivables reconstruction. Next, we have the cash payments to suppliers, which consists of inventory and trade payables. So you first need to figure out what the inventory purchases are for the period. Then you place that purchases amount within the trade payables reconstruction to determine the cash payment to suppliers. Next on the list, cash payments to employees. Sometimes this can be merged with other operating expenses as well, depends. I usually like to separate items out so they directly reflect the T account or reconstruction ledger account that I've prepared in the calculations leading up to the statement. But the cash payment for employees consists of things such as provisions for annual leave, sick leave, long service leave, and we collectively call that the provision for employee benefits. So determine the amount that's actually paid there. Then there's cash payments for other operating expenses. So if there's an opening or closing balance, need to reconstruct that first. And then we've got income tax paid. If there's no deferred tax asset or liability to consider in the question, it's pretty straightforward. It's just figuring out what the actual amount paid for the period would be. So it would be the opening and closing current tax liability and the income tax expense to figure out the amount paid. However, it can get a little bit more complicated when you've got to consider the deferred tax, because you also need to consider how they have affected the income tax expense account. So you'll first need to figure out the opening and closing balance for along with the expense related to those respective accounts before you determine the income tax, the current tax liability, and the income tax paid for the period. Not all questions do contain deferred taxes though. And then last we've got interest paid, and yeah, straightforward with that account as well. But all those accounts, unless stated otherwise, would go in the operating activities statement. Now I'm just looking at the financial reporting handbook. I've got the 2016 handbook in front of me, and on page 657 you can see a statement of cash flows there using the direct method. So within AASB 107, the illustrative examples, it's got on this page 657, it's got a direct method there, and it's got all these accounts listed. And this is really useful because obviously you can take the handbook into the exam with you. So this would be a good page 2 tab should you need to prepare a cash flow statement in the exam, because it is half the battle is trying to remember all these account names. Anyway, I think we've done enough talking about what's going on with the statement of cash flow, so let's look at an example now on the next slide. So our example is calculating cash receipts from customers, which was the first item on the list on the previous slide for operating activities. And as it says here, Bobcat Group Limited had sales revenue of $6,930,000, a doubtful debts expense of $11,000, and a discounts allowed of $4,750 for the year ended 30 June 2014. The accounts receivable balance for the group was as follows. So we've been given the opening and closing balance for both the accounts receivable and doubtful debts, and with this information we need to calculate the cash receipts for the year ended 30 June 2014 using the above information. So there'll be two parts in the process of answering this. We first need to determine the bad debts written off for the year, and then using that figure we then can calculate the physical cash received and cash repaid using the accounts receivable accounts as they both relate. And because we haven't been given a opening or closing balance for the discounts allowed, that will be the actual amount we apply within the accounts receivable reconstruction, which we would expect anyway with a discounts allowed. So the first account we need to reconstruct is the allowance for doubtful debts. And here we have it presented in a T account format. And the process we go to figuring out this bad debts written off, which is the figure we're looking to in reconstructing this account, is we would start with the opening balance of $9,500. We would then, how I would go about it is then write the closing balance, which would be written on the opposite side of the normal balance. So the normal balance for accounts allowance for doubtful debts is a credit balance. So the opposite balance to that, because to reduce the balance, is the closing balance, so $12,500. The third step in the T account reconstruction process would be to enter the doubtful debts expense. Because why is that a credit? Because usually an expense is a debit. So why are we putting it on the right hand side of the T account, you may ask? The reason is that an expense increases the balance of allowance for doubtful debts. So by putting the expense here, we're increasing the balance, which is what would have happened during the period. So that's the third step. The fourth step is to calculate what the total would be for this column. So it's normal balances total column. So it's a credit here, so we'll do the right hand side first, and that's $20,500. Then we enter that information here, $20,500. And so we've been given what the total balance should be, we've been given the closing balance, therefore the amount remaining, it must be $8,000, and that is the bad debts written off figure. The next step is to take that bad debts written off and prepare the accounts receivable T account. So that would be a credit as well, because that would decrease the accounts receivable balance, and the normal balance for accounts receivable would be a debit. So we can write that there first, knowing it's a credit, and we'll write the opening balance of accounts receivable, which was stated in the question as $189,000. We're also told what the sales amount was, which was $6.93 million. And the sales is usually a credit balance, yes, and why are we putting it as a debit? Same principle as before with the doubtful debts. The sales increases the accounts receivable balance, therefore we put sales over on the left hand side of the T account. We also need to consider that discount allowed, $4,750. That would decrease the accounts receivable balance as well. So because it's decreasing the accounts receivable balance, it goes on the right hand side. And we also need to consider the closing balance, which is $246,500. So we've entered all that information now. We don't worry about this cash received now, even though it's shown here. We're not worrying about it for the moment. We'll get to that. So the total of sales equals $7,119,000. So we'd write that again on the right hand side, the opposite to the normal balance of the T account, and the residual figure to get the T accounts, because we've got to get both sides of the equation balancing, is $6,859,750. And this is what will be posted to the consolidated statement of cash flows as cash receipts from customers. Now looking at another example which involves the cash payments to suppliers for inventory. So this will be an outflow from operating activities, and the information provided to us says that Bobcat Group Ltd had the following balances for the year ended 30 June 2014. So they're giving us the inventory opening and closing balance and the accounts payable, which directly relates to inventory. And we've also been told what the cost of sales was for the year ended 30 June 2014. So with this information we need to calculate the cash payments to suppliers, and we'll go over to the next slides now, and we will prepare some T accounts. So to calculate the cash payments to suppliers, this is also a two-part process, and I think I mentioned this a couple slides ago, but the first process in this is to calculate what the inventory purchases are. So to do this, and I've got the solution up here, we start with the inventory opening balance of $170,000. That's on the left hand side because the normal balance of inventory is a debit. Then we would put in the closing balance, which is $210,000, and that reduces the balance to figure out what the purchases are, so we put it on the right hand side. The next step is to add in the costs of sales. So the costs of sales decreases the inventory balance, because when we sell a good, we credit sales, debit accounts receivable, then we debit COGS and credit inventory. So we put this on the right hand side, so it might just take a little bit of practice just to remember which side of the T account to put the balances on, but just remember cost of sales is on the right hand side. And from that we can calculate the total, which is $1.91 million. And then the next step, so we've done step 1, 2, 3, 4. The fifth step would be to write the total here, which is 1.91 million again, and the difference between the opening balance and the total is $1.74 million purchases. So we take that information and we now create the accounts payable T account. So the normal balance for accounts payable is a credit, so we'll put the opening balance here, which is 51,000. Next, closing balance on the left hand side of 65,000. Third, let's put in the purchases from what we calculated up in inventory. Or you could do this first if you like. You don't have to have opening balance as the very first thing here. Like, this is just the process I'd probably go through. Next, you would calculate the total of the two on the right hand side, so it's normal balance 1.791, and we'll put that over here, 1.791 million again, and the difference between the total and the closing balance is $1.726 million. So that would be the cash payments to suppliers. That would be an outflow within the operating activities. One other thing to note, if you have a look at the AASB's illustrative example, it's got cash paid to suppliers and employees as an outflow. So it's actually combined two different outflows into one. So it would include this outflow, the cash payments to suppliers, and also the cash payments to employees. So that employee benefits provision, figuring out what the actual amount paid to employees during the period is combined. So when that happens, it's just a matter of adding both the payments together. If you like, if you're worried about making a mistake or something, it's fine to split them up. We won't be penalising you for not combining accounts within the cash flow statement, like in this respect, if you wanted to split them up. If you do combine them, it's a good idea to put, say, an asterisk or a little note next to the account listed in the statement, and just tell us down below the statement as to what that total figure is made up of. So cash payments plus to suppliers plus cash payments to employees equals this figure. And one more example, and this will involve calculating the cash flows for property, plant and equipment. So this will be an investing activity, and the question says information extracted from Bobcat Group's financial statements for the year ended 30th June 2014 regarding plant and equipment are as follows. There was plant with a carrying amount of $10,000, and it was sold for the year for $22,000. So that's given to us. The actual proceeds received, that would be a cash inflow, and the amount's $22,000. So that's easy enough. But it's the outflow is usually the one that requires the work. We've been told in the second point there that the depreciation expense, which is a non-cash item, was $5,000, but we'll need that for our calculations. And the balance from the statement of financial position includes the 2014 closing balance, the 2013 closing balance, 12,000, 20,000, and the accumulated depreciation, 7,000, 5,000, and that equals a $5,000 carrying amount for 2014 and 15,000 for 2013. And with this information, we're going to calculate the outflow, as in the cash outflow for purchasing this plant and equipment during the year. And the way I'm going to show you on the next slide is using the gross method, where we include the accumulated depreciation in the calculation, but within the reading there's also a net method you can use. Depending on the information provided to you in the question, can determine which way you can do it, but we're going to do the gross method on this next slide. Okay, so first we had that proceeds from plant sold, $22,000. So when we sold that that item, that was the amount we received, so that would be considered the cash inflows, and that would be placed within the investing activities of the cash flow statement, and that's all we need to do for that. The work's going to be in calculating what the outflow is for cash paid to acquire property, plant and equipment for the period. So to do that, using this gross method, first we need to calculate the disposals in relation to the accumulated depreciation. So if we look at the opening balance of accumulated depreciation, which was $5,000, and then the closing balance, which is $7,000, we can therefore, based on just looking at those two figures, we can say it's increased during the period, meaning there's been depreciation added. However, the depreciation expense is $5,000, so that doesn't coincide with the same amount. So it's increased by $2,000, but the depreciation expense is $5,000. So obviously the difference between the two must be due to a disposal of property, plant and equipment, because that's the only reason that accumulated depreciation account would decrease. Because when you remove an asset from the accounts, you remove its respective balances. So the opening balance is a credit of $5,000, and accumulated depreciation, it's a contra asset account, and it sits on the credit side therefore. So we put that in first of $5,000. Next up we've got the closing balance, we'd add that in, which is $7,000 stated in the question. And third step is depreciation expense. So when that gets, when you debit depreciation expense, you credit accumulated depreciation, so we put that on the right hand side there. And the total of $5,000 plus $5,000 equals $10,000. Next step is we put the total down here of $10,000, so we know the total is $10,000, the closing balance is $7,000. Therefore the disposals, as in what's been removed from accumulated depreciation during the period, is $3,000. Therefore we can now calculate what the original cost of the plant that was sold was. And we were told in the question that the carrying amount of the plant sold was $10,000, but what was it including its accumulated depreciation? What was the original cost amount? $10,000 plus the $3,000 from here equals $13,000. So with this information, the next step is to calculate the actual purchases of plant and equipment, and we set up a T account for plant and equipment and would add in the opening balance, which is $20,000 stated in the question, and the closing balance of $12,000. So plant and equipment's normal balance is an asset, so hence being on the left hand side there. The next step is to use this figure we calculated, the $13,000 of the original cost of the plant sold during the period, so that equals a total of $25,000. We now add that figure to the left hand side of the T account and compare that with the opening balance. $25,000 less $20,000 equals $5,000, and that's the physical cash purchases of plant and equipment during the period, and that would be considered our cash outflow from purchases of property, plant and equipment for the period within the cash flow statement. Okay, so we're going to go through a bit more of a comprehensive question now. It's still a basic example, as in it's a parent with a wholly owned subsidiary, no controlling interest, and there's actually no acquisition or disposal of a subsidiary in this question as well, which is the main part of this topic that makes it go to the next level from first year accounting. So I'd recommend either referring to page, I think it starts on page 418 of the reading, and having this next to you when we go through this question, or having the slides printed out in front of you, as I'm going to be referring back to this slide and a few of the other slides going forward whilst we answer and reconstruct each account of this question. So anyway, let's have a look at what's written in this slide. So yeah, again, page 418, and this is taken directly from the reading, so you should be able to follow. That's why you should be able to follow from there as well. So anyway, we've been given the statement of comprehensive income, aka the statement of profit and loss and other comprehensive income, for the year ended 31st of December, let's say 2011, of Macquarie Group. We've been given the sales revenue, 700,000, because we're dealing with hundreds of thousand here. There's a profit on sale of equipment. There's cost of sales, depreciation, other expenses, tax expense. Okay, so, and no comprehensive income to think about, so there's been no revaluations there, which is good. Alright, so we're sort of just scanning through the accounts at this stage, just seeing what sort of items we're going to have to deal with when we reconstruct what's actually being paid or received during the period. Let's go to the next slide now and look at the statement of financial position. So here we have the statement of financial position of Macquarie Group, and we have property, plant and equipment, which in 2011 was 1.535 million, and in the previous year it was 1.2 million, so it's increased 335,000, and that doesn't necessarily mean that there's been that amount of purchases of property, plant and equipment as well, because there could be outflows as well. So that's why we're going to need to do some ledger reconstruction with the property, plant and equipment and accumulated depreciation. We've also been given inventory, which has changed balance, same with accounts of trade receivables. We've got a term loan, and there was no term loan in the 2010 year, so that would be 75,000 received during the year. We've got a change in the trade payables account, and same with income tax payable. The issued capital's changed amounts, so that means there's been an issue of capital and an inflow from issuing shares there. A change in the general reserve as well, and retained earnings. So we're just, as I mentioned with the previous slide in the statement of profit and loss and other comprehensive income, we're just scanning through the accounts now, getting a bit of an idea on what's changed during the period. And let's have a look at the next slide now and look at this consolidated statement of changes in equity. So in this financial statement we have a bit more detail as to how the share capital increased from 1 million to 1.32 million during the period, and we can see here there's proceeds from share issues, and there's actually shares issued to acquire land, so that's a non-cash transaction. We've also got the change in retained earnings, and there was a transfer there from the general reserve, so there's a change there that's not cash related, and this is all important information that we need to know. And there was a dividend paid, and we've been given the totals of the equity balances there. Alright, so we've looked at the three financial statements now, and we'll go on to the next slide and look at some additional information that's been provided to us that will help in answering the question and allow us to prepare the consolidated statement of cash flows. So the additional information says that during the 2011 financial year we had firstly land with a fair value of 200,000 been acquired in exchange for 50,000 ordinary shares issued by the parent entity. And that information just confirms what we saw within the consolidated statement of changes in equity in the previous slide, that we had that shares issued to acquire land 200,000. Then in B it says that there's a bank term loan of $75,000 arranged and immediately used to acquire new machinery. So we know what that inflow of $75,000, which we saw on slide 23, that term loan, what that was being used for. Then in C, plant and equipment that had cost $60,000 and had an accumulated depreciation attached of $20,000 was sold for $45,000 cash. And I recall on slide 22 we had that account below sales revenue which said profit on sale of equipment $5,000. So if we compare it to what it says here in additional information C, it says that cost of $60,000 less accumulated depreciation equals $40,000, and it was sold for $45,000, so there was a gain there of $5,000. Then in D it says that all sales and purchases of inventory were on credit terms, and so by saying that, they're just confirming that the same cash received or paid during the period as what's recognised within the sales and COGS accounts respectively. So same as using the periodic system of accounting for inventory. So then in E it says the other expenses of $210,000 shown in the income statement were all paid in cash. That's just confirming that there's no opening and closing balance attached to that. That's all been physically paid during the period, and that would just be an outflow within operating activities. And also in F it says income tax provided for the 2010 year were paid in 2011. So in the 2010 year on slide 23 it says that the income tax payable was $90,000. That would be the amount that was actually paid in 2011. So that's the figure we will use there. Nice and easy, don't need to worry about deferred tax assets and liabilities in this question. So we'll go over to the next slide now, as there's two more pieces of information discussed there before we answer the question. Okay, G says that all the dividends during the year ended 31st of December 2011 were paid. So that $50,000 we saw in the statement of changes in equity, that was actually paid. And H says that the accounting policy of the group is to use the direct method to report cash flows from operations, which is good because we don't do the indirect method. Okay, so we'll go through the process now of answering this question, and when you have to do one of these by yourself, use the handbook as a reference because you've got that template there of answering it. There's a process to go through, and it's just a matter of practicing your reconstruction of accounts again and again, and it gets easier each time. So as they say, practice makes perfect. Here we have the solution, the statement of cash flows for the year ended 31st December 2011. Usually, I guess we wouldn't start with preparing the statement because there's a few workings that need to go on prior to preparing this statement. However, just to try and explain this through the lecture slides, it's better just to have the answer up here, and we'll go through each component, each account within this statement, and I'll sort of provide some extra details as to how each one was calculated and which one will have the calculations provided on a slide coming up. So let's look at the cash flows from operating activities first, and the first one is the cash receipts from customers, so the accounts receivables and any allowance for doubtful debts, all that. That's what that is related to. That's $730,000, and that's calculated in a couple of slides, so we'll go through that in a minute. Payments to suppliers, that is another ledger reconstruction was required to calculate that, so we'll go through that in a minute. Then we've got this payments to employees and other of $210,000. If we look back at slide 25, additional information E, it says that the other expenses of $210,000 shown in the income statement were all paid in cash. So looking back even further at slide 210, we can see that expense of $210,000. So that's a direct cash outflow. So that's why it's called. It's just as is, straight from the question. No workings required behind that. We've also got income tax paid of an amount of $90,000. So I mentioned this earlier a couple slides ago, but just to explain again, additional information F says that income taxes provided for in 2010 were paid in 2011, and then looking back further on slide 22, we can see that slide 23, we had the income tax payable in 2010 as $90,000, so that would be the amount that's paid in 2011 there. And that's it for operating activities. Next, we're going to look at the cash flows from investing activities, and we had the proceeds from the sale of plant and equipment at $45,000, and that was told to us directly within additional information C. It said that the plant was sold for $45,000, so that would be the inflow of plant and equipment. The outflow, which is the payments for property, plant and equipment for $195,000, we're going to have to calculate that, so that will be done on the next few slides. We've also got this proceeds from issues of shares. So from looking at slide 23, we noticed that our issued capital increased from 1 million to 1.32 million during the period. And if we looked a bit more closely at the changes in equity statement, and we noticed that the breakup of that $320,000 increase was made up of $200,000 from the shares issued to acquire the land. I'm looking at slide 24, and the proceeds from the share issue was $120,000. So that was the actual cash received for issuing new shares. So that would be considered an inflow from financing activities. We also have this proceeds from borrowing, $75,000 inflow. So that was mentioned in additional information B, that bank term loan of $75,000 came in. It was a financing activity for new machinery, and we also saw that from looking at slide 23 with that new term loan coming in the 2011 financial year. And we also had this dividends paid, which was discussed on the previous slide, that $50,000 dividend paid, and we also saw that within the statement of changes in equity on slide 24. Within the retained earnings account, we saw that dividend paid $50,000. So that's how the consolidated statement of cash flows is presented. All three of those figures totaled, so operating, investing and financing, are placed over to the right hand column, as you can see there. And as we'd expect, operating activities is a cash inflow. If it's an outflow, usually that's not a good sign for the entity. And investing activity, that's an outflow, and financing activity is an inflow. So adding the three of them up together equals $190,000, and that's the change in cash held during the period. So it's actually a net increase from the period. And if we look at the cash and cash equivalents at the beginning of the period with the cash and cash equivalents at the end of the period, as we can see on this slide, it says the opening balance was $185 and the closing balance was $375. The difference between the two is $190,000, which matches up with what it says in this statement. And that's a really important verification tool, because if you look back at the question, say slide, where is it, 23, we can see those figures, and our goal when we've completed this question is to ensure that the net increase there marries up with what we've calculated in our solution from the operating, financing and investing activities. So that's the statement of cash flows. We're next going to look at a couple of the notes that are required as well with the statement of cash flows. Then we're going to look at how we calculated some of these accounts that required the ledger reconstruction approach. You may have noticed when we were looking at the cash flow statement on the previous slide that when it stated cash flows from operating activities, there was a in brackets note 1 written, and that is in relation to this statement, which is prepared within the notes of a financial report. So what this is a reconciliation between the cash flows from operating from the operations of the entity and profit for the period. So how we do this is we start with profit for the period and we add back or deduct the changes in balances that relate to the operating activities for the period, and if we've done everything right, we should be able to reconcile the cash flows from the operating activities, which we calculated on the previous slide, to what we get here. So for this example, we added the expenses not from external transactions such as depreciation expense, so that was stated in the question as 15 on slide 22. So we're adding that to the profit for the period, and then we had a profit on sale of equipment of 5,000, so we're going to deduct that from profit. Next we're going to look at the changes in the trade receivables balance. So the opening balance was 190 and the closing balance was 160. So we're going to add that decrease to the reconciliation. And we've got the income taxes payable. So on slide 23 again, it was a closing balance of 90,000, then the closing balance that became the opening balance for the current period, and the closing balance for the current period was 92,000, meaning there's been a $2,000 change in the period. So we add that increase for the current liability for the period, and then we're going to deduct the change in inventory balances, which was stated on slide 23 as $75,000 opening balance, closing balance 80,000. So there's a $5,000 change there. So it's increased during the period, so we'll deduct that. And then trade payables, that's moved from 120,000 to 110,000. So we'll deduct that decrease in trade payables there. So the total change, adding up all those accounts and deducting from profit for each respective account, equals 195 adjustment, which is reconciled to what we calculated on the previous slide. There's also a second note we need to disclose, which is information about non-cash financing and investing activities that occurred during the period, and this was mentioned on an earlier slide, and that's also stated in AASB 107 paragraph 43. So one of the major events that happened in this question was that during the year Macquarie issued 50,000 shares in consideration for the purchase of land which was deemed to have a fair value of $200,000, and we saw that within the consolidated statement of changes in equity on slide 24, and it was also mentioned on slide 25 within additional information A. So in the next few slides, now we'll go through how we derived the cash flow amounts that were placed within the cash flow statement for certain accounts. So when preparing the reconstructed accounts, the first one we always start with is the cash collected from customers, which is found by reconstructing the trade receivables account. And because this isn't a very comprehensive question, there's no allowance for doubtful debts to consider as well, which just makes it a little bit easier. So whilst the presentation of this method is different to the T accounts, the notion behind what's going on is exactly the same, and you can choose either this method or the T accounts. Either it's fine. The reason we're teaching you both is the prescribed text uses this method that's shown on this slide. However, T accounts might be something you remember from first year, and second year from previous subjects, so we include that method as well. So using the textbook method, we'd start off with a balance of 190,000, which was the opening balance of trade receivables, and I'd probably, if I was doing this, I'd leave a little bit of a space and then write the closing balance of trade receivables, which was 160,000. Next, we can add in the sales revenue, which was stated on slide 22 as 700,000, and therefore the opening balance plus the sales revenue, which is a debit because sales revenue increases the trade receivables balance, less the closing balance. The difference between the two is 730,000. So that is the cash receipts from customers, and that's the amount that appears on slide 27 as receipts from customers there. Next, we have the cash payments to suppliers of inventory. So this would be the second account you reconstruct, the inventories and trade payables account. So with this, remember there's a two-part process in this always two parts. So I guess accounts receivables sometimes depends on how comprehensive the question is and whether there's an allowance for doubtful debts. But with this one, there's always a two-part process because you have the inventories you first need to reconstruct, then the trade payables. So first up, we'll start with the opening balance of inventory stated in the question, slide 23. So that's a debit of 75,000. Then the closing balance of 80,000. That's a debit. Then we had the cost of the sales, which is a credit balance because when we debit cost of sales, we credit the inventory, so that's why when that occurs, it's a credit balance for reconstructing the account. Then the missing amount, so the balance of the opening balance 75,000 plus the 220,000 less the 80,000 equals a difference of $225,000. So that's our purchases, and that flows down to our trade payables account. So we see that inventory purchases 225,000 as a credit there. That's because it flows down to that account. So with the trade payables also stated on slide 23, we had an opening balance of 120,000, a closing balance of 110,000, and using this purchases figure we calculated 120,000 plus 225,000 minus 110,000 equals the cash payments from inventories of 235,000, and that's what appears on slide 27. So that's the process. The only time it can become a little bit more complicated, and this rarely happens in the question, but when there's a write-off of inventory because of, say, obsolescence, spoilage, or theft. But that doesn't happen too often. And now on to income tax expenses. This is a nice easy one. We're told in additional information F on slide 25 that the income taxes provided for in 2010 were paid in 2011. So just verifying with the account balances there in the statement of profit and loss and other comprehensive income and the statement of financial position, we had a opening balance of 90,000, closing balance of 92,000, and the income tax expense was 92,000. Therefore the cash payments were $90,000. So it's pretty straightforward. because it's the tax expense paid in this example. If, however, there was movements in the deferred tax asset and liability accounts, then we would need to take them into account as well, as the income tax expense wouldn't equal the current tax payable. So to determine what the changes are in those balances, it's the difference between the opening and closing balance. So if its normal balance increased during the period for a deferred tax asset or liability, so the normal balance for an asset is a debit and the normal balance for a liability is a credit, you would do the opposite balance within your reconstruction account. For example, if deferred tax liability increased during the period, which means the liability increased, you would debit within this income tax payable account for that change. Likewise, if it was a deferred tax asset that increased during the period, you put the movement difference in the credit side. And so you would need to add those two accounts within this reconstruction of income tax payable, and then you would determine the difference between adding and deducting to determine what the cash payment of tax was for the year. So we've now completed the cash flows from operating activities, reconstructing the accounts that needed to be in order to determine the cash paid or received during the period. Now we're moving on to cash flows from investing activities. As it says here, they usually stem from the purchases and the sale of property, plant and equipment and investments, and also the acquisition and disposal of subsidiaries, which we'll look at in the next objective, and it's not part of this question anyway. And as the last point says, usually necessary to reconstruct the property, plant and equipment ledger account to determine if there's any cash acquisitions from this category of non-current asset. So usually the question won't tell you that there's been a cash purchase of an asset, a non-current asset. However, you can work it out from reconstructing the accounts just like we have done here. So we've got this information sourced from the financial statement and also the additional information A and C. So this is using the cost method, like the gross method. It's not taking away the accumulated depreciation. So slide 23, we get the opening balance of property, plant and equipment, which is 1.2 million or 1,200, and the closing balance, which is 1.535 million. And then we have, let's look at this issued capital, so the land acquired. Now it wasn't a cash transaction, but we need to use this $200,000 in calculating what the cash payments were because it's related to this account. So there was a debit of land, 200,000, then there was a credit on the other side within share capital of 200,000. So we need to debit this reconstruction as part of the reconstruction, and that's what that is in relation to additional information A. So the cost of the plant and equipment that was sold was $60,000, so that would be a credit to the account as it decreased the balance, and therefore if we were to go the 1.2 million plus 200,000 less 60,000 less 1.535 million, the difference between the two equals our cash payments. So this reconciles to slide 27 as payments for property, plant and equipment, $195,000 within investing activities. So that's our outflows. Our inflows were given to us in a question, so we didn't need to do any reconstruction to determine that, and that's all we have to do for investing activities. Now looking at the cash flows from financing activities, and these typically include cash flows from share issues or buybacks, new borrowings or repayments of borrowings, and cash dividend payments. So we needed to figure out via a ledger reconstruction what the proceeds of issues of shares were, or I guess we could have figured this out without having to do a reconstruction because it's the only difference between the opening and closing balance of issued capital, as the other 200,000 was due to that plant revaluation, which is paid for from issues of shares. So that was told to us in additional information A, and we looked at that in the previous slide with our property, plant and equipment reconstruction. So I guess you could do it without it, but rule of thumb, general rule, it's best to do reconstruction of the ledger accounts if it involves both cash and non-cash entries. And if the question says there's marks awarded for showing you're working, of course, definitely go with that. So in this question we can see that there's an opening balance of 1 million and a closing balance of 1.32 million, and the property, plant and equipment 200,000. Therefore we've got this proceeds from share issues, which is the actual amount received from issuing new shares, 120,000, which is the missing information. So that's it for learning objective C. We've gone through an example now, and this is based off the textbook, so I'd recommend, as well as part of your study with this objective, to now read through the respective pages for this objective, as it just provides a little bit more detail than the things I've been talking about. And then you can move on to learning objective D, where you have a go at another question. We go through another question like this, but it also incorporates a subsidiary being acquired during the period.